All right, welcome back to the Flipping Junkie podcast. Today I've got Sean Pan on. He's a hard money lender, out-of-state real estate investor, and host of the Everything Real Estate Investing Show podcast, which happens to be pretty top notch. You only let people go on that show that are like the rock stars of the industry, right?
Just like you.
I'm just kidding. I'm only saying that because he had me on his show recently, and so anyway. Yeah, cool. It's a really good show with some great episodes looking through the different ones on there. So if you haven't checked out the Everything Real Estate Investing Show podcast, for sure do. Welcome to the show, Sean.
Yeah, Danny, thank you so much for having me on today.
Yeah, so as usual, I like to start out with your story. How did you get excited about real estate and what's your story of coming to where you are today?
Yeah, so when I was growing up, I had no intention of starting any business, no intention of buying real estate. In fact, when I was younger, I convinced my mom not to buy a rental property because I thought, this is a bad investment. You should invest in stocks instead. Then as I got older, I went to college, I studied engineering, and I thought I'd be working a full-time job as an engineer, making a nice salary, buying a house, and doing the normal stuff. But very quickly, after working for this company for maybe 2 months, I realized just how much I didn't want to be there. I didn't really enjoy the work. It didn't feel like I was fulfilling any purpose. But even more importantly, I noticed how unhappy my coworkers were. These people were maybe 20, 30 years older than me. And they would always tell me about how they regret not taking more chances when they were younger, how they regret not even trying different companies. They stayed with the same company for 30 plus years. I didn't want to be like them, to be honest. Like when I saw what I could become 30 years from now, it didn't seem great. They weren't happy with what they were getting paid. They weren't happy that the company was always taking away their benefits. So I figured, okay, time to try to start my own business and let's make something happen while I'm young. So I actually tried many different businesses. We had a small startup company with some of my friends. I started selling products on Amazon. I was selling some ebooks and whatnot. But eventually I found out about real estate investing. And the beauty of real estate investing is how an average person with no particular set of skills can actually become very successful and create this amazing business. And that's how I got interested. I started, consuming a lot of content, like different podcasts, going on different websites and forums, going to meetup groups and talking to people. And then eventually, by hanging around so many people, I decided to take a plunge and invest in some out-of-state properties. So then I bought some rental properties. I started flipping houses locally here. And then eventually I decided to create my own podcast, YouTube channel, meetup group, which then led me to leaving my full-time job as an engineer and then getting picked up to becoming a hard money lender. So I left a full-time job thinking I would never work ever again. And then now I work again now as a hard money lender because it fits so well with what I like doing. So that's my story in a nutshell.
Nice. You did much better at sharing your story than I do. I ended up going into too much detail and end up spending like 30 minutes talking about like a certain part of it. It doesn't really matter that much. But yeah, that was succinct and really gives the idea of where you were coming from, where you are today. And what's the timeline on that? How many years ago was it that you got started to today?
Yeah, so 2011 is when I first started working in the corporate environment. And, coming from school, I thought I was very excited. Right? I was like, oh, wow, I can work at this top-notch company and I can do a lot of cool stuff. I was working as a defense contractor working on satellites. So this was really awesome. But then, yeah, during that year, that's when I saw that my coworkers weren't really happy. I saw what they were actually making as a salary. And I'm like, wow, you've been working here for a long time and you only get paid this much. It's like, it doesn't really make sense. And you're happy with this too? So around the 2012 area, that's when I picked up Rich Dad Poor Dad. I was just walking through Barnes and Nobles and I saw this interesting book. Oh, this is interesting. Read through it, changed my life. Definitely made me more interested in the business side of things. But 2013, I was kind of looking at properties. I was thinking of house hacking down in Southern California. But I didn't actually buy my first property until 2015 when I moved up from LA to the Bay Area. But when I bought that property, that was just for me to live in. I did house hack it. I did have some of my other friends from Los Angeles who moved up to NorCal live with me. And it wasn't until 2016 that I actually bought my first rental property. And then that's when I started buying rental properties, flipped houses in 2017 and 2018. And here we are today.
Nice. Yeah, it's interesting because I think we share the same background a little bit with working for a defense contractor and seeing how unhappy people did seem at that job that have been there for a long time. And when you talk about looking at what they're making and going, wow, you've been working here for that long and you're only making that, it reminds me of, I think Jim Rohn maybe had said this, but I'm sure many people have said this, but it's this idea of you get paid for the value that you provide, right? And so many, I've been caught in this for a period of time, and I'm sure everybody has at some point, but you learn some skill and you grow and you provide that value, and then you just keep, sometimes if you get stuck in a job where there's no growth, you're just repeating that year after year. So you could say I've got 10 years of experience, but really what you have is 1 year of experience repeated for 10 years.
Yep.
Right. So there's not much of a reason other than inflation to be getting a higher salary. So it's an interesting way to see things. And we can, as business owners, even get caught in that trap of I'm providing the same value I was providing last year. Like if I need to, if I want to grow and have more fun and expand, maybe I'm too much in a comfort zone. And I'm only bringing that up because it's interesting to see that you got into real estate investing and then went into hard money lending. Like you didn't stop at where a lot of people do stop and just continue to do that thing over and over again. Mm-hmm. And so let's talk a little bit about that. How is the, what is the hard money game like? What is it like?
Yeah, so I guess we can start with what is hard money in the first place.
Sure.
I mean, I'm sure many of your listeners already know this, but for those who don't, hard money loans are going to be loans that are based on the hard asset itself. So we're going to look at the deal versus on your credit worthiness. Now, of course, we're still going to do a background check and do a credit check, but we don't care too much about your debt to income ratio like many conventional lenders do. We're going to be able to lend on a property that is in poor condition. Like if it's missing a kitchen or bathroom, you can't get a loan from Wells Fargo or from Chase. And of course, we can close a lot faster than other lenders. So we close in 10 to 14 days, whereas most loans take 30 plus days. So if you have a seller who needs to sell their home ASAP and they're willing to sell it to you at a discount, that's where hard money loan would come in, because you can get in there, buy it, and then fix it up or refinance into a longer term loan.
Yeah. So what is let me think of what a good question might be with this for the audience. So if someone's making an offer on a property that's listed and they say, well, we want to see your pre-approval letter, what do they do if they're going to get a hard money loan?
Yeah, they should definitely contact a loan officer. Like you can contact me if you're looking to get a loan with us, or if any other hard money lender companies out there. Talk to a loan officer and just tell them what you're looking into, what your buying criteria. The loan officer will probably ask you two sets of questions. One is about the property or about the deals that you're trying to buy. And the second one is about you. So for the deals you're trying to get, they're going to want to know property address, purchase price, rehab cost, and ARV, or after repair value. Now, of course, if you're just shopping around, you don't even have a property, you can kind of just tell them an example, like, oh, I'm looking for properties in this price range with this much rehab and this much ARV. And then they're going to ask you questions about yourself. So what's your approximate credit score? How much do you have in liquid funds? Like how much do you have in cash? How much do you have in stocks? What can you show on paper? They're also going to ask you your experience. Like, have you done multiple deals in the past 3 years? If you said, oh, I used to flip a lot of properties, but that was 20 years ago, that experience probably isn't super relevant. And if you're like a general contractor, you say, oh, I do like 20 projects a year. But if they're not your own projects, that probably wouldn't count as experience either, because you haven't taken the risk, you haven't put the thought into the actual investments. All the information combined will give the lending officer a good idea of what they can lend you. So if you say, oh, I want to do all this, but I only have $4,000 in my checking account, the lending officer is going to be limited in what they can give you on a pre-approval letter. But if you say you have enough funds for maybe a $500,000 project, then the loan officer can give you a pre-approval letter for that $500,000. So you can submit it with your offer. Now, this is a little bit different from your conventional lenders. When conventional lenders send you a pre-approval letter for like $500K, you're pretty certain that you're going to get it. With a hard money lender, every deal is still unique. So they still need to do their own due diligence and underwriting per property. And that letter is more so something that you can use to submit with your offer to make the listing agent feel comfortable with your bids. But it's not like a binding agreement that we're going to guarantee it.
Right. And I think that's the reason why a lot of the agents that are selling REOs or, properties that need a lot of work require so much in earnest money. right?
Mhm.
Because they, as a listing agent, don't want to put something under contract and have it fall out. Because
Or worse, I've seen some people, they get it under contract and then they try to wholesale the deal, right? And then when they wholesale, it doesn't work out and then they have to drop out.
yeah, yeah, and so it wastes people's time. But how? So will you work with somebody that's not done a deal yet?
Yes, we do. We do all the time. There's different tiers to how we do pricing, how we do terms, and experience is one of those leverage factors that someone could say, well, I've done plenty of deals. Can you give us a lower rate? I've done plenty of deals. Can you give us more leverage? That's probably what we can do. But if you're a new investor, we're probably going to be limited. Like, for example, for our company, if you're a brand new investor, we can probably only limit your loan to 80% of purchase and 80% of the rehab cost. Probably can't go to like 90 and 100 like we can for our more experienced investors.
And that's just so that they have skin in the game and you guys are a little bit protected, right? In case you have to
Exactly.
take the property.
Exactly.
Right. And so and that's what happens, right? Like if the loan is defaulted on, then it's just like a foreclosure, right? I mean, you can
Yes.
do a deed in lieu or something like that.
Yeah. I mean, luckily for me, like none of my clients have lost their properties. So I haven't had to go through any of that. But yeah, that's essentially what would happen if you didn't make your payments anymore. We would start the foreclosure process and try to claw back as much as we can get.
Right. What is it like for handling draws? You guys, because you do some of the rehab
Yes.
funds, you said even up to 100% for experienced ones that you've had experience with. But for any of them, how are the draws handled?
Yeah, it's a great question. So draws are something pretty complicated that many new investors like have no concept of what that is. So let's give a quick example with some numbers.
Sure.
Let's assume you're buying a property and you need $100,000 to rehab your project to its full glory. And let's say we give you an 80% loan on that rehab budget. So at closing, we don't just give you $80,000 and say, hey, here's $80,000, have fun, buy whatever you want, and pay your contractors. That's not how it works. We're going to hold $80,000 in a reserve escrow account. And you will be the one setting these different milestones. And you're going to be paying for these first milestones. And we're going to reimburse you. That's how draws work. So as an example, let's say phase one is to do demolition and maybe put up new drywall. When you're done with phase one, you call us, say, hey, I'm done with phase one. I paid all my guys. I paid for all the materials and everything's installed. We'll send an inspector over to you. We'll double check the work, take photos. Our contracting team will review all the invoices. And if it's approved, we'll reimburse you for what you spent on that first milestone. In this case, 80 cents on the dollar for what you spent. And we'll just keep doing that for every phase. And every time you do initiate a draw process, they usually charge you around $265 per draw.
And I think whenever I was getting started, I would view a situation like that as kind of limiting, like it was sort of a hassle, right? That I would have to put up with. But knowing what it's like working with contractors, and I'm not saying that all contractors are this way, but someone that doesn't know what they're doing can easily be taken advantage of by a contractor. And I view this now as really a protection for the investor themselves, because if you're not given all of that, because there are contractors out there that will say, look, this is a $40,000 rehab, give me 20,000 up front. And that immediately is like a no, like heck no, like, right. And if you're not getting those draws, you can't do that. So it's going to protect you from that even.
Yeah.
And then having those draws set up will kind of teach you and protect you from giving too much in advance, because sometimes contractors are behind on one project, so they have to start another one to get some money to finish the last one. And it's a common thing. And so what ends up happening is that you pay and then you don't see them for a week or two, and then they're just like, and it's not all contractors, obviously, right? But so this kind of helps with that. So and I understand why you guys do it too, because you don't want too much going out and,
Yeah, I mean, we were just talking about this at a meeting before this call, and we're saying, like, how come we don't reimburse on like rough materials versus we do it for installed materials? So like usually for investors, you have to buy all of your materials up front, probably put them in the garage, and then as you do your projects, your contractors go in your garage, grab the materials, and install them. Well, it's like if we fund on just the rough materials before they're installed, then someone can easily just go in the garage, grab those like tiles, and then bring them to another job site, right? They're not installed. It's not adding to the value of the property. So that's why we can only do draws on installed materials and finished labor.
Yeah. Have you experienced a case or many cases where you'll be asking for draws when the work isn't done yet?
I mean, I guess over the phone, they might ask for it, but we can tell them right away, like, don't bother, because every time you send an inspector over, they're going to charge you $265. So if they go over there and they see that your tile isn't, installed, they're not going to give you the draw. They're not going to release the funds, and you just wasted $265.
So who are the inspectors? They're local. I mean, yeah, they're local to wherever the job site is,
Correct.
and
Yeah.
they're actual like property inspectors.
I'm not sure exactly who they use. They're all like third-party inspection companies because
Okay.
we're a company based in California, but we do loans across the nation. So
Okay.
it really depends on like who is the person for that area.
Okay. And I'm sure anybody that's listening is probably wondering, and I'm sure we'll get to it, but what are the typical terms that you guys are offering? What are people looking at terms wise?
Yeah, I mean, again, it depends on your experience and your leverage. Those are probably the biggest factors there. But generally speaking, for like an 80% LTV loan, you're looking at around 8.5% for the note rate, which means that on a yearly basis, if you held on to the loan for a whole year, you would pay 8.5% on the loan balance. And that's interest only. So generally speaking, for hard money loans, they're all going to be interest only. And you're also going to be paying origination fees. So you might hear like rate and points when you're talking to a hard money lender. Points are just like an upfront cost that adds to your closing cost. And it's like the percentage of your loan balance. So again, for 80% LTV loans for first time borrowers, we can generally do it for 1 point. So we're actually pretty good on our fees. That's why I like working with them. It's really easy for us to sell our loans because our pricing is pretty good. So again, for those who don't know what that means, 1 point just means 1% of your loan amount. So
Yeah, paid as a fee, right? So
paid as a closing fee. Yep.
yeah. Yeah, that actually seems pretty good. I mean, whenever I was back, I mean, I don't know how many years ago this was, like looking at terms for hard money lenders. I mean, it was stuff like 14% and then like 2 points, sometimes 3 points, just like pretty high,
Yeah.
pretty tricky stuff. So I don't know how things have changed in the industry with regards to that, but that does sound way better than that for sure. 1 point. And then they're paying monthly or all paid at the end?
Usually it's paid monthly.
Okay.
So usually, like, let's say if you close the middle of the month, you would have paid for the rest of the month at closing. And then the first month, you don't have to pay because you're still working on it. And then you start paying the next month. But yeah, you paid every month.
And do you have an option for extension if the 12 months it's not sold?
Yes. So usually you can pay 1 point up front just for another like 3 months. Generally speaking, the extensions are usually good twice. You can only pay 1 point every 3 months for 2 times. So most people just refinance. They're like, let me just get another loan. By the time my project is 12 months deep, supposedly like it should be worth more, right? Because the property value probably increased, and maybe I, improved it, so it looks a lot better. So my loan to value is going to be a lot lower, and therefore my rate's going to be better too. So most people just do that. They refinance after a year.
Nice. So do you have any pointers for anybody listening that's preparing to do either more deals or do some of their first deals? What should they prepare in order to speak to you or any hard money lender? And maybe the better thing is, like, what questions should they ask a hard money lender? Like,
Yeah.
things that might come up that people need to be prepared for.
I mean, rate and term are probably the most prevalent questions that everyone asks. Like, hey, what are your costs for this hard money loan? Oh, how do I qualify? And to prepare, I guess, maybe have a good estimate of what your credit score is. Are you in the 720 range? Are you in the 650 range? That makes a slight difference. Tell them like how much experience you have, like how many properties that you've had on title in the past few years. You should also know how much money you have, like liquid. So some people, they watch videos or the podcasts and they hear, oh, I can get in with zero money down. There are lenders who do that, but they charge a lot, just like you were mentioning, maybe 15% and 3 points. Like if you have a pulse, they'll give you a loan, right? But they'll charge you a lot of money for it. But if you want like a better rate, the hard money lenders want to know that you have enough money to successfully complete the project. So if you have enough money for the down payment, the closing costs, the rehab costs, and maybe 6 months of holding costs, that's how much of a loan they can give you. It can be based on a number.
Right. So you have any interesting stories of, any lender situations or, investor situations gone wrong?
Oh, okay. So yeah, I do actually.
Okay, go.
I had a client. He's a young guy, very energetic, very excited to get into his first real estate deal. And he was telling me, yes, I have enough money for the down payment, all that stuff's all good. But when we get to closing, the closing day, usually they wire their funds to escrow for the down payment, and then we wire our funds for the rest of the deal. For some reason, he decided to have his mom wire the funds directly into escrow, even though his mother isn't associated with the deal at all. When you do that, it looks like there's a random third party that's funding your deal. And that almost killed the deal for us. Like, we don't want to have a random third party person who's not associated with the deal funding the down payments. The money should come from the client or from the LLC that the client controls. That caused a lot of headache. We were able to negotiate things with the client, but it was a pretty sticky situation with a lot of back and forth calls with the agent, escrow officer.
Yeah, it's amazing. That's something that you wouldn't think. It's like, well, what does it matter as long as the money's there? But yeah,
exactly. He's like, oh, it's my mom. Like, why does it matter? But that's why we were able to make it done. Like, all right, at least it's your mom. It's not some random third party person.
Yeah.
Yeah. I did have another. Oh, go ahead.
Oh, you don't want to find out you're in second position on it, right? I mean,
yeah, that too. Another issue that we had recently is, again, I guess like a title issue. We were funding a deal with a title company that we use all the time. And for some reason, they required all of this documentation from our clients. Our client was a managing member of this LLC with multiple partners in it, but the escrow company wanted all the financial information from all of the members of the LLC, and both parties wouldn't budge. It was a really sticky situation. And even after we sent them the information, they're like, no, we won't do it because this loan seems too risky. I don't even know how to tell the story right, but like, I had to pull the stops and like find out the heads of the escrow and title company and like figure out like, hey, how do you like manage this so we can get this loan done? And after like a month and a half, we got this done. So
wow, yeah, that's crazy.
But it's these things you would never know, right? You would never know that your loan could be at risk because of title and escrow. They're supposed to be very simple to work with, but yeah, sometimes they hold things.
Right. So do you work with any title company, or is it, or you guys kind of like sometimes say, hey, let's switch it to some other title company?
Yeah, so it's not up to us generally. Usually the sellers are the ones who choose the title and escrow company when they list it on the market. So the buyers, our clients are repeat buyers, but they don't have the choice, right? It's whoever the seller opened escrow with. And only if things really go wrong, that's when I suggest to my buyers, hey, let's just change title. It'll add another week to the process, but better than losing the deal, right?
Right. Yeah. Yeah. Because I mean, there's some title companies that just are not friendly to doing things in any way that's out of the ordinary of somebody buying the house to live in and all that kind of stuff. So it gets to be tricky.
Yep.
Yeah. So who are your favorite clients to work with?
My favorite clients to work with are my friends. So I'm a real estate investor myself, and I've been going to meetup groups for 5+ years before I was even in hard money. So I've built quite a strong connection with friends in the industry. And whenever they need a loan, I'm like, yes, let me hook you up. So it's obviously the best. They FaceTime me, we chat if there's ever an issue, and they're the easiest ones to work with for sure. And of course, now we've been doing it for 5+ years all together. They know what they're doing. We know what we're doing. And like everything runs really smoothly. It's usually like the newer clients who don't really know what's going on. They're the ones, again, who like might mess things up and are a little bit more difficult to deal with because it's their first deal. They're very nervous. So, our job is also to like make sure they're calm and like everything's going well. Like, don't worry, it'll work. Yeah.
So you guys walk them through and handhold a little bit to help out. Yeah.
I mean, that's part of the job, right? It's like, it's service, right? We have to make sure that they feel good. I mean, as no example, when I did my first flip project, I was working with a broker and we had some issues too. We had some issues with title again. But I feel like this broker handled it very poorly because I would call him asking for an update and he would just stop answering my calls. Like he wouldn't talk to me for 3 days straight, not even like text me back, email me back, nothing. He basically ghosted me because he probably thought the deal was dead. But I feel like even if you know the deal is dead, you should still talk to your clients, right? You should still give them the service and tell them, hey, it's okay. Like, here's what we're doing. Here's the updates. Like, I don't have an update, but at least I'm on the phone with you talking to you. It gives you some more reassurance, right?
Yeah, nice. So if anybody out there listening is interested in getting a hold of you to find out, to talk about this even further for their specific situation, what's the best way for them to reach you?
Yeah, if they want to, they can reach me at my email. It's Sean, Sean, at everythingrei.com. So REI like real estate investing. So everythingrei.com.
And Sean is Sean.
Sean.
Right.
Yeah.
And then you guys have like you have something going on, right? Where you have like a new sort of product, right?
Yeah. So this one's really exciting. And actually, that's the reason why I like coming on the shows because, hard money loans cool and all, but I feel like people understand what hard money loans are. But for a long time, people were asking for a 30-year fixed loan product. But they had all these complications like, oh, what happens if my debt to income ratio is too high? Like I bought this property here in the Bay Area. I bought a lot of rental properties and now the banks won't give me more loans because I have too much debt. Or they have student loan debt, right? Like they don't have, or you're an entrepreneur, you don't have income. Or what if you have 10 plus loans? Then again, the banks won't give you a loan anymore either. So in the past, people were using private money loans, getting loans from their friends for like 8%, and then buying these cash flowing properties with an 8% loan on it. Well, now we have a 30-year fixed loan product with rates as low as 4%. That's going to be based on the income that the property generates instead of on your debt to income ratio. So technically it's still a hard money loan, but it's a 30-year loan product. And so we're doing this for tons of our clients. Like they have these huge portfolios. They were using maybe commercial loans, or maybe they own them free and clear now, and they want to free up some capital to then buy more properties. But they don't have jobs anymore. They're either retired or they're entrepreneurs, or they don't have a solid source. So we're able to do these loans for them and get them at 4% for 30 years. Yeah, they cash out like $1 million. And they're like, I have $1 million now at a 4% loan. Like they're chilling. Yeah.
Yeah. So 30-year amortized, fully amortized loan, 30 years.
Yeah. So we have 4 different types. One's a 30-year fixed product. One's a 5-1 ARM, which means that for the first 5 years, the interest rate's fixed. Then every year after that, it readjusts. 7-1 ARM, very similar to the 5-1, except the first 7 years are fixed. But then we also have a 10-year interest-only version. So you can buy a 30-year, or you can buy a property with a 30-year fixed loan, but the first 10 years are interest only. And then the next 20 years is where you pay off the rest of the loan. So it becomes like a 20-year AM loan. So that's really cool. Like it really boosts your cash flow for the first 10 years, and then you pay off the loan in the next 20. So yeah.
Interesting.
Yeah.
Yeah, that's really, I haven't heard of others offering that. So that's really cool. And I feel like often needed, right? I mean, if you're not fixing and flipping something, you want to have a long term, and then you guys are looking at not debt to ratio or income to debt, but you're actually looking at what that produces. So what's it like? What's an example property for a loan like that with, let's say a property generates, like what's a common one you guys get for
they're probably going to be in the $300,000 to $500,000 range. That's like the property value. And then it should rent for, about the 1% rule, right? $2,000 to $3,000, $2,000 to $5,000 a month. And the way we calculate if it qualifies is through something called our DSCR, so debt service coverage ratio. We check and make sure that the DSCR is 1.15. There are many ways to calculate DSCR. Our company calculates it a little bit differently from other commercial lenders. We take your gross income. So let's say your property is making $2,000 a month. So the top number is 2,000. And then on the bottom, we use something called the PITIA. So PITIA stands for principal, interest, taxes, insurance, and association dues. Basically, these are the 5 things that you're gonna have to pay on this property, no matter how efficiently you run your property, right? So if that ratio of cash that you get in divided by your PITIA is above 1.15, then the property is good and we can lend on it. We do make some exceptions here and there, but it increases your rate. One thing to know as well is that this loan does have a prepayment penalty on it. So if you were to sell or refinance within that prepayment penalty period, then you do have to pay like a small fee.
How long is that typically for the prepayment?
In general, it starts at 3 years.
Okay.
And it's paid in a 3-2-1 like step down basis. So if you sell or refi in the first year, you pay 3% of the loan amount as a penalty. On year 2, it's 2%, and on year 3, it's 1%. And after year 3, you have no more prepay penalty.
Right, and it's got to be a rental property, right? You can't be living in the.
Yeah, all of our loans, hard money loans, like for bridge loan and for long-term rental loans, they all have to be for business use or investment. Use. You can't live in it, unfortunately. But yeah, you can Airbnb it. So as a rental property, if you do a long-term rental or Airbnb, we can also do those loans as well.
Oh, so you said you can do it for Airbnb.
Yes, you can,
Oh,
but the
interesting.
leverage is lower. So for single family homes, we can lend up to 80%. For duplexes, 75%. So duplex to fourplexes.
Hmm.
For 5 to 8 units, we can lend up to 70%. And then for Airbnbs, only up to 65%.
Okay. Interesting.
Yeah.
Very cool. So I guess if anybody wants to reach out and find out more, let's repeat that again as far as your email address.
Yeah. You can reach out to me, Sean, SEAN, at everythingrei.com.
That's awesome, man. So yeah, that's cool to find out that you guys have those products available this day and age. I'm sure there's a lot of people are looking for something like that and just haven't heard of it or haven't seen it. So it's cool to come on and share that.
Yeah,
Uh,
absolutely.
yeah. Do you have anything else that you'd like to share for the end of the show here for anybody listening?
Sure. So again, like you mentioned, if you guys are interested in checking out the podcast, I have the Everything Real Estate Investing Show. We have over 230 episodes launched so far with great guests such as yourself. We talk about different real estate investing strategies. Honestly, like one of the great reasons why I like doing a podcast is because I get to meet amazing investors like yourself and also hear all of your stories and incorporate into my businesses. I also do host a YouTube channel. You can find it at youtube.com/SeanPanREI, where I go over different real estate investing concepts twice a week. And of course, I do have a meetup group with around 2,400 members. We are meeting virtually because of the coronavirus, so you can all still come join them while we still have online sessions. And that can be found at meetup.com/everythingrei.
Nice. Very cool. Well, it's great to have you on the show. Thank you so much.
Yeah, absolutely. Thanks so much, Danny. Take care.
All right, you too.